All right, those are stocks with news and results, etc., which we'll get to in just a bit. But Arvind Sanger is our global guest to get a bigger overall perspective, managing partner at Geosphere Capital. Arvind, it's always a pleasure. Great to have you with us here. Thanks very much. Markets are back to trading like, someone cancelled the Fed pivot. Oil is down, yields are higher, dollar is stronger, equities are lower. Just put this into context for us. And, between when we saw peak hawkishness, etc., and where we are now, one was bound to see this changing views and volatility, etc. So I guess that is playing out. But is this the start of something new? Or you think we are in the midst of one of those kind of confusing market phases right now?
Well, look, I've been of the view that Goldilocks was a lower probability and that inflation was going to reappear and people were getting too optimistic and it was a bear market rally. And I remain of that view that the last couple of months of hope that somehow inflation was going to magically disappear. Look, inflation has come off the highs. That part is over. The question really is inflation going back to the levels that the Fed hopes and wants it to come back to, which is in the 2%, 2.5% range. And I've been of the opinion, and that the recent data confirms it, that while the goods inflation has come off sharply, services inflation and other factors that are more sticky are going to make the job harder. And therefore, if you ask me today, where do I think Fed funds rates could go? I think the Fed fund rates could end up at 6%. I don't think that's outside the realm of possibility at all in terms of what it will take to bring inflation to a level that the Fed will be comfortable with. Therefore, I think that the market got a little too optimistic too quickly, and I think we're facing that. And India had inflation data that surprised a few days ago on the upside. So this is not just a U.S. phenomenon. This is a phenomenon around the world that inflation is coming down, but is proving stickier on the way down than people had hoped, the central bankers had hoped.
So what does all of this mean, Arvind, for a market like India? Because, the narrative is that it's going to be a painfully frustrating year for Indian investors, where because of the higher rates, the market is not going to move anywhere, and perhaps you could even see a time-wise correction. Is that your prognosis too? And if yes, how does one approach it?
Well, I think one approaches it with patience and with being willing to pick individual stocks at levels you want to own. Because the reality is there are two or three things that have created headwinds for India. One is obviously, as we all know, the Adani story has caused some money to leave the market. The second is China reopening. I think that's been a big factor. India was a big beneficiary last year till late in the fourth quarter of China, shooting itself in the foot with its own zero COVID strategy. And as that is unwound, China has gained, and other markets, India was one of the biggest winners in emerging markets, have lost. Nothing wrong that India is doing, but it's a little bit of giving back for some of the benefits last year. And the third now is obviously the persistence of inflation. And so I think, yes, it requires a little bit of patience, but I don't think the Indian growth story, medium or long term, is broken. I think the stocks have gotten a little ahead of themselves in terms of valuations, and the earnings need to follow through, and it'll take a few quarters for us to get to where the market and the multiples and the valuation make sense. Because in a 6% Fed interest rate environment, PEs around the world, not just India, PEs at the S&P and others are reflecting a much, much more benign discount rate. And I think that if we use a slightly more higher discount rate, then PEs need to reflect that reality.
All right. Hi, Arvind. Morning. I recall, when you joined us at the start of January, you were telling us that since the China reopen trade is a big factor, maybe energy as well as metal stocks could be on the buy list. Do you hold on to that view, or have you seen that post the new year, the China reopening is not as robust as expected?
Well, look, I never said that China reopening would happen in January and February. I said as we get past Chinese New Year towards the second quarter, we will see it. Metals and mining stocks, are up about 6.5% year to date. So last year, energy was the leader. Metals and mining was the laggard because China is much more important to the metals and mining sector than to energy. This year, I think that metals and mining will continue to see more response as we go later through the year. But keep an eye on China's revenge travel. I think that's coming in a big way. forward data on travel and everything else is showing that there is data that China had pre-bought and put on tankers a lot of oil from Russia that they didn't need last year while the lockdowns were taking place. So some of that is being drawn down. But recently, one important data point is that VLCC, very large crude carrier rates, have started to move up contra-seasonally quite strongly. And if that continues, that's a sign that China's demand is starting to reemerge on the oil side. So I've not at all written off the oil side. In fact, I'm keeping a very close eye on the tanker rates to see what's coming. So my view is that, yes, China will be a factor. China was a factor in driving inflation because of supply chain challenges 12 months ago. In the last 12 months, those have come back. But China could be a factor in driving some commodity inflation as we go through the year, and that's something we're keeping an eye on.
So if you do believe that the India story is not broken just yet, despite higher rates and slower growth, where do you see opportunities for Indian investors now? Is it in the IT space that's still struggling to recover a bit? Is it in banks? Where do your preferences lie?
Well, look, banks were very popular last year, right? They worked great. So banks are seeing a little bit of profit taking, as we can understand. But, we find selective opportunities in banks that are not gone away, because again, in a cycle which is going to be recovering, I think Indian banks will be well positioned, but we need to be selective because some of the valuations have run a little bit. So again, selectively we are buying banks. We still like domestic and infrastructure and other spending-driven beneficiaries. We like companies in the power and related. We think that power demand in India is going to be extremely strong, and we think that the underinvestment in anything except renewables is going to continue to create power crises in India because renewables can help you during the time when the sun is shining and the wind is blowing, but otherwise there's going to be issues. So that's an area where we think investment is going to be needed and opportunities will exist. And then, selective companies across sectors we see, but we think that, the IT sector is one we're not in, we're keeping an eye on, but, it's somewhat dependent on U.S. economic outlook. And if we think a U.S. recession is coming, maybe we need to wait till a little bit till buying that.
Okay, always a pleasure speaking to you, Arvind. Have a great day and a great week ahead. Thanks a lot for joining in and speaking to CNBC TV 18. Well, that's Arvind Sanger saying that the India's growth story is not broken just yet, but there are pockets like IT which they're not yet touching. They're still a bit wary considering that we could be heading into a US recession. Let's take a quick break on that note. On the other side, our entire research team joins in to help us with the top trades for the day and the top stocks in the news to watch out for as well.
Different ages, different stages.